And even the mainstream media now is coming out and talking about this, saying Canada needs to prepare as the risk of bank runs rises, warns a report. And this sold for $1.575 million in 2022, January, and it just sold for $1.275 million, $300,000 loss. Royal Bank of China, I mean, Canada is bracing for layoffs as thousands of jobs could be on the chopping block right now. So let's get right into it. So Royal Bank of China, Canada fear layoffs, has pledged to keep HSBC's staff near's end, sources say. Some Royal Bank of Canada employees who joined when the bank acquired HSBC Canada worry that they could lose their jobs when RBC's 6-month guarantee to keep them expires this month. And obviously, you don't really have to be a rocket scientist to go into the repo market and see that volumes have been exploding. So there's definitely distress within the banking system. So you can see layoffs. I don't think it's going to be anything to do with the actual HSBC merger, more just a liquidity problem in general, which could be occurring at any of the chartered financial institutions. I mean, take a guess, but you can see from the repo market volume that has exploded, the banks just don't want to lend even in the repo market, which is meant to be super safe and liquid. So it's very interesting what's going on. You've also got the OSFI, which is just letting mortgages get more risky now. So the OSFI relents on stress tests for uninsured mortgages when lenders switched at renewal. And you know, I want to point out actually that many of times when people renew as well, they're not even getting a credit check. I mean, it's just absolutely insane, I know, to say that banks would not credit check their customers when they renew them, but a lot of banks don't do that on renewal, which is just, again, people might say, oh, this is great because it allows people to renew who haven't necessarily got that good credit or might not even pass the credit check criteria. But what does that say about the bank's asset side of the balance sheet, which is comprised of these dodgy loans and mortgages? And we're talking about uninsured mortgages now, even though those can be insured by the CMHC, and the banks mostly up until about 3-4 years ago were purchasing mortgage insurance for all these uninsured mortgages as well, which is backed by the taxpayers' buck, because why not? So after rejecting a call by Canada's Competition Bureau to treat mortgage stress testing equally at renewal, regardless of whether a borrower stays with the same financial institution or switches to a new one, the country's top banking regulator has had a change of heart. Quinn Watson, Manager of Communications and Parliamentary Affairs at the Office of Superintendent of Financial Institutions, oh my God, that is a mouthful, said Wednesday that the regulator plans to inform the banking industry formally in November that straight switches of an uninsured mortgage to a new financial institution will not require the new lender to assess the borrower using the minimum qualifying rate stress test. And you know, do you remember how many people were saying back in 2020, in 2021, and even in 2022, up until they started jacking up rates, there were so many people, very, very popular people on social media in Canada, and they were saying, hey, we should just scrap this stress test. We don't need this stress test. And look how high the stress test is right now when you can get a mortgage for 2%, 2.5%. And then we look literally a couple of years later, and it turns out, well, it was actually sort of a good thing having that stress test in place, because guess what? Rates actually went up to that, and even more possibly than that with the interest rate hikes that we saw. So kind of crazy, but this just, I want to highlight again that a lot of times when somebody renews, they're not even getting a credit check, let alone the stress test. So it goes to show the risk on the Canadian financial institution's balance sheet. This is really much to do about nothing. It's not going to affect many people. So the qualifying rate for an uninsured mortgage is the contract rate plus 2 percentage points or 5.25%, whichever is greater, and was put in place to help ensure borrowers could handle an increase in interest rates or higher household expenses over the mortgage period. And it was a failure, a complete failure in a way, because did it actually show that these people could handle these higher payments? No, not really. Yes, it did kind of safeguard them to a certain degree, because they could say when they took out the mortgage, oh yeah, these people can withstand these payments, but obviously we know how much inflation has gone up. We don't have to be very smart to work that out, that over the past 3-4 years you're looking at least 30-40%. So even excluding the mortgage, the amount of cost increases that people have took and their wages haven't gone up that much. We've barely seen any positive wage growth at all. In fact, if we go to this chart, which I made, and it kind of shows you what I'm talking about here, you can actually see that there's been barely any positive real wage growth. In fact, if you look at this yellow line here, focus on this yellow line, because this is adjusted for the realistic inflation rate, which I basically just use shadow stats, which might even slightly understate inflation as well, but it's using based the 1980s CPI. So it's interesting, but if you look, you've only seen during 2008, 2009, it popped up, you got 0.7%, 0.7%, not even 1%, 0.7% real wage growth. And then obviously during the height of the pandemic, complete insanity, where they basically did unprecedented amounts of stimulus. You also had people not paying their mortgage, not paying their rent, and you saw it soar up to 1.23%. And then down here, during the depths of this inflation crisis, you've seen minus 12% real wage growth. So it just really goes to show what's happening. So even though you're having these changes with mortgages, just realize that they mean absolutely zero. They mean nothing. So basically, it's all much ado about nothing. And it's really what's going on at the banks. And even the mainstream media now is coming out and talking about this, saying Canada needs to prepare as the risk of bank runs rises, warns a report. So Canada may not have had any big banking failures in many years, but emerging clouds on the horizon and balances may need tweaks to be sustainable in the future, says an official who worked for the country's top banking regulating agencies, which would be the OSFI, who we were just talking about here, who are coming out saying, yeah, doesn't matter anymore. Stress tests when you switch at renewal. But I said, like, this is much ado about nothing. But yeah, when you look at what's going on, what this regulator does, do they really do enough? Absolutely not. And when you've got just massive market distortions, which are created by the government in the form of the CMHC, because that is just a huge distortion and people really don't realize the extent of that. And obviously the taxpayer can't cover that either. So the fact is, when this all comes to fruition, because this bubble cannot continue indefinitely, it gets to a point where people can't even make the debt payments on their debt anymore. That's why you had so many people that were in negative amortization. So many mortgages are still in negative amortization. That happens when people can't even cover the interest for their mortgage, let alone the principal. So we've already got to that point. It's blatantly obvious. So it's just a case of, well, what happens next? And you're already beginning to see a lot of these banks are taking huge losses. So for example, this house in Mississauga, again, this is Shazzy who put this out there. So give him a follow on Twitter, because he's always putting stuff like this out and his work is fantastic. Even the mainstream media follow along with all the losses that he posts, and you can just see what's really going on in some of the biggest housing bubbles in Canada, like Toronto and the Greater Toronto area. So this was sold in April of 2022 for nearly $2 million, and it just sold for $1.65 million, which still nobody can afford and is completely insane. But that's a huge loss, $328,000. If you include inflation over the past 2 years, you're probably talking nearly $500,000 the person has lost in their purchasing power. And do you think people really have these large amounts of money just saved up waiting to give to the bank when they take a loss on their house? Absolutely not. The banks are going to be taking a hell of a loss. These people are in front of the curve, in front of the fear. And it's not just that. Brampton, this was nearly $500,000 loss. So the home sold in 2022, February, and it sold for $1.67 million, and it just sold for not even $1.2 million. So a $487,000 loss. And then if we move on now to North York, you can see this sold 2022 again in February for $1.56 million, and it just sold for $1.22 million. $347,000 loss. And you're looking at a suburban house in the Greater Toronto area, but you have to remember that the CMHC largely distorts this market. So a lot of the numbers, 1.22 million, it could effectively be in a different currency, because when it comes to housing and spending money on housing in Canada, it's not the same as when you're going into the grocery store. The government is heavily distorting that market. They are in there actively saying, hey, if you give this guy a loan, we'll insure that loan if they default, and then we'll charge them as well. So there's no cost to you. And basically, it's all good as long as you make the checks, and they don't a lot of the time. And it's not just places like North York. You've got Hamilton here. So Hamilton, $250,000 loss. Again, February 2022 becoming a common theme. $1.55 million, and it just sold for $1.3 million effectively. So $250,000 loss. Hamilton, if you were commuting to Toronto, is over 2 hours away. I mean, you can get there on the GO train, but it's just completely insane, these prices, when there's just no way to explain it. You know how people used to explain Toronto housing prices, and they used to say, oh, well, it's just because Toronto is a world-class city. And that's because those people haven't traveled, obviously, because once you travel outside of North America, you realize like Toronto is not a world-class city at all. But anyway, they can't even say that when you're talking about places like Hamilton that just went into insane bubbles. And of course, a lot of the people that bought in these places as well, they were people who wanted extra space, and they moved from the city. You know, maybe they had a condo and they moved to Hamilton, and now they can't sell and they've been called back to the office. So it's worth noting that there's a lot of that that's going on. So this Clarington in Newcastle, again, a long way away from Toronto, and this sold for $1.575 million in 2022, January, and it just sold for $1.275 million, $300,000 loss. Again, this is kind of like a regular upper middle class home, I would say, and you're talking $1.2 million. I mean, in reality, this sort of house should probably be around $600,000, if that. If it wasn't for the insane leverage that people are able to take, these prices would not be as high as they are today. But obviously, we're seeing that in reverse right now as the tide is going out. So it's very, very interesting what's going on. These losses are undeniable, in my opinion. You just can't deny them. So anyway, if you've enjoyed this video, I'd highly recommend that you check out this video here. And if you're looking for a VPN to protect your privacy, go to expressvpn.com/marketmania. And I will see you in the next one. Take care.